Now, this chapter, it will help you for decision making in terms of how to identify the costs, how to use the costs, how to use the volume, and how this is going to affect your profit. The technique is called cost volume profit analysis. And obviously, you have to prepare this cost volume profit income statement so we can determine the contribution margin. And then we have to calculate the break-even point. And then we have to do some other stuff we're going to see today what exactly it's going to be about. Now, this analysis, again, we're going to analyze how the changes in cost and volume is going to affect the company profit. If I sell more clothes, what's going to happen with my profit? What's going to happen with the cost? If I reduce my sales, what's going to happen with the cost? What's going to happen with the profit? And we have to consider interrelationship between 5 elements. First one is the volume of activity. Can be sales, can be usage of material. We have to identify the unit price for a single unit. We have to remember how the costs behave. Remember, variable cost per unit always stays the same. And fixed cost in total stays the same. And the last thing that left we have to do is to deal with the sales mix. What if we're selling more than one product? What's going to happen in that case? Before we go further on the analysis, we have to make some assumptions. First assumption is cost and the revenue behave in a normal way, mean a linear through the relevant range of the activity. Means cost per unit, variable cost per unit stays the same. Fixed cost in total stays the same. And revenue is driven not by the sales price, but the number of units. So the sales price stays the same. Second assumption is all the costs can be identified and separated by only 2. Either their variable cost, either their fixed cost, nothing else. Now, the changes of activity is the only factor that drives sales and the cost. That means the unit cost per unit stays the same, and the total cost in total stays the same for the variable and the fixed cost respectively. And the same thing is equally correct for the sales price. Still, sales price stays the same. The other assumption is inventory level stays the same. Means if we didn't have any inventory in the beginning of the period, we don't have any inventory at the end of the period. So what that means is we're selling exactly the amount of the product that we produce. And the last thing is when we're selling more than one product, the sales mix between those 2 products remains the same. Means we're not shifting sales from one product to another product once we see one product is profitable than the other one. So why do we need this? How to do this? First, cost volume profit analysis. Income statement is the starting point. That's prepared only and only internally. And again, we're classifying the costs only by 2, fixed or variable, nothing more. That income statement is going to report contribution margin, on which contribution margin represents the sales minus the variable cost. Or in other terms is, so what's the amount that we need to achieve as a company in order to cover our fixed cost. So now we're coming to the last one, which is the traditional income statement. So this is the contribution format income statement. Let's make it a little bit more simple at this point. Let me flip to Excel spreadsheet, and I'm going to start from simple Excel spreadsheet, and we're going to go further. So you can understand the whole relationship and all the analysis in the very simple way. And then we're going to come back here to the slides, and we're going to talk about more about the slides. I'm waiting for my Excel to start acting. And once I have it done, I'm going to show it my screen. Okay, I'm ready to share my screen. And let's share my screen. That should be simple, empty Excel spreadsheet. So basically what I'm going to try to do is recreate the Excel spreadsheet that's already posted for you on Brightspace. So first thing first, there are two types of income statement. One is the traditional, and the other one is contribution margin. Now, both income statements going to start with sales. There's no magic here. Both income statements going to start with sales. Both income statements going to have a mid calculation, which will be related to the sales minus something. And both income statements going to finish with operating income. Now the question is, what's the middle section? So on the traditional income statement, after the sales, we have cost of goods sold. And after cost of goods sold, we have gross margin. That's the first calculation. Gross margin is calculation, right? So if my sales are 100 and my gross margin, let's say, is 20, my cost of goods sold is 20. My gross margin in this case is $80. That's obvious for everybody. Then I have operating expense. Let's say operating expenses are 60, and my net operating income, let's call it operating income, in this case is $20, right? So now what's going to be different in the contribution format income statement? Again, we're going to have calculation here, and we're going to have operating income at the end. Now, again, operating income, since the only thing that I'm doing is, so watch this. The only thing that I'm going to do is I'm going to pull this cost. Let's insert one of those. Let's insert a few things. What I'm going to do is I'm going to pull this $20 and I'm going to move it here. Then I'm going to pull this $60 and I'm going to put it here. Make sense? So my total cost obviously is $80. If my sales are 100 and my operating income is 20, my total costs are $80. There's no magic in that. Then I'm going to look how these costs behave. And I'm going to say, okay, those costs are either variable cost, either fixed cost. There's nothing else. And I'm going to pull those 80 from here. I'm going to move them. Variable cost is going to come as a variable cost, and fixed cost is going to come as a fixed cost. And that's all I'm going to do. So now in this case, my sales are still 100 Let's say my variable cost is 60. Now, in the middle, we're going to have mid calculation, which will be my contribution margin. And in this case, contribution margin is going to be $40, obviously. And what's left for the fixed cost in order operating income to be 20? Fixed cost is $20. So in that case, my operating income is contribution margin minus the fixed cost. It's 20. So what I want you to understand is this thing already happened. This thing already happened. That's already in the past. We run the company had sales, had the expenses and everything. Operating income for the last period was 20. Now, for the management purposes, what we're going to do is we're going to pull out the costs, which are constitute the cost of goods sold and operating expenses. We're going to check how this cost by cost, how this cost behave, either variable, either fixed. And then we're going to prepare for the management purposes and management purposes only this contribution format income statement to help the management to make decision. So what kind of decision the management can make? So let's start with this. This is a good starting point. I'm going to copy this. I'm going to flip it here. Now let's make it more realistic. Let's pretend we're selling only one unit of sales. We're selling only and only one unit. So if we sell one unit, it's a big company. So if we sell one unit, we sell it, the selling price per unit is $60. Variable cost for that unit is $100 sales price, $60 is the variable cost. Contribution margin is 40. No questions about it. Let's make the fixed costs a little bit more realistic. Fixed costs, which is our insurance, our utilities, our rent, our security and everything. Let's say the fixed cost in this case is $2,000. That's more realistic number, right? That makes sense. So let's format this cell, put the right number with the separation and no zeros. So what will be my operating income? My operating income, obviously, if I'm selling only one unit, one item, obviously I'm not gonna make profit. I'm losing money. How much exactly I'm using? I'm losing my fixed cost. I cannot cover with the $40 contribution margin. I cannot cover the $2,000, but I'm covering only $40 from my fixed cost. So I'm losing 1,960, which is the fixed cost minus the contribution margin. Let's see what's going to happen if we sell 2 units. If we sell only 2 units, let me put it like a 2 only here. If we sell only 2 units, my sales will jump to, obviously, to $200. What's going to happen with my variable costs? Well, they're also going to double. What will be my contribution margin in this case? Also is going to double. So there's 2 ways to get the contribution margin. Here's going to get the contribution margin per unit times the number of units that you're selling, or you're going to get sales minus the variable cost, which will be equal to exactly the contribution margin per unit times the number of units. Why is going to be that? Because we are not changing anything. We're not changing the sales price. We're not changing the variable cost. As long as we're not changing anything, our proportion is going to stay the same. And the only thing that now start driving the contribution margin, sales, and variable cost is the number of units. If I continue with that one, remember one of the conditions was sales price. The costs are linear. Means the only thing there is as a proportion, they stay the same. The only thing that drives them is number of units. More I'm selling, sales going up, cost going up, contribution margin is going up. So how about the fixed costs? Well, they're also linear. Means fixed cost in total stays the same. They're not changing. So where is my operating income in that case? Well, my operating income now is a little bit more different. How much different is that it's still negative. Don't get me wrong here, this one minus that one. No, actually they are opposite way. This contribution margin minus the fixed cost. That should be the right thing. It's still negative, but can start getting closer to zero. By how much? By exactly, as you can see, exactly the difference now is, let me see if I can find the right shape here. The right shape should be, let's do it, this one. Move it a little bit, and now the exact difference between those two now it's $40. From where the $40 came? The $40 came from the contribution margin per unit. Why? Because we're selling one additional unit. So the contribution margin from that additional unit now transfer into increase in our operating income. Make sense? So what we can conclude from all these things, what we can conclude, we can clearly see that sales minus the cost is equal to operating income. That's out of question. Make sense? Tell me that you understand. If you don't, I have to go a different way. Now the question is, what's the cost? Can you guys hear me? Hello?
Yes,
Yes,
sir.
yes,
We can hear
Okay.
you.
So the cost, what's the cost? As we can see here, we have only two costs. We have variable cost and we have fixed cost. That's all. Nothing else. Those are our only two costs. Variable cost and fixed cost. So then what's the operating income? From where the operating income is going to come? Well, the operating income is going to come with the sales minus variable cost minus fixed cost, and that's going to give us operating income. Correct? If you break it by pieces. So now, first crucial point of the company is to bring that operating income to zero. What that means, to bring the operating income to the to cover all the costs. Means that sales are equal to the cost, and in that case, my operating income is going to be equal to zero. That's the first crucial point. Now, how can we do that? Well, again, the sales minus the variable cost minus the fixed cost should be equal to zero. That's my break even. Let's see something else. Sales minus the variable cost, what's gonna give us? That was the first calculation, right? Sales minus the variable cost is gonna give us contribution margin, correct? So, what that means, only and only when the contribution margin, which you're generating from the selling your products, it's equal to the fixed cost, only and only in that scenario, your operating income is going to be 0. Make sense? If I have here 2,000 and the fixed cost stays the same, which they're going to stay because that's our assumption, only in that case, I'm going to have 0 operating income. When this becomes 2,000, my fixed costs are 2,000, and then my operating income is going to be 0. Make sense? So what's my objective? My objective is if I know the sales minus variable cost contribution margin, then I can substitute here. I can get the contribution margin minus the fixed cost is to be equal to 0. So my objective is to get contribution margin to be equal to fixed cost. When I get this done, magically, contribution margin equal to the fixed cost, I'm at break even. That is your break even point. You're not losing money, you're not making money, but you're covering your cost. How can we do that? Well, before we go there, let's do something else. Let's go here and see something in other, what else we can get from here. Since you know the ratios and how we're using the ratio analysis, our sales are always 100%, correct? Sales is always, in the income statement, sales is always the starting point. Sales are always 100%. Now, the question is, can I express my variable cost as a percentage of sales? Who's going to stop me? So how much will be the variable cost divided by sales? And that will be percentage. Now, the other question is, can I express my contribution margin as a percentage of sales? Well, again, who's going to stop me? Let's insert here one row. So that will be the contribution margin divided by sales. So what I get? My sales, 60% from my sales, on the sales that I'm getting, for every dollar sales that I'm getting, 60% or 60 cents goes to cover the variable cost, and the other 40% stays in the company to cover everything else and to generate operating income. That's if we sell 1 unit. Let's see what's going to happen if we sell 2 units. Well, again, variable cost ratio is going to be variable cost divided by the sales. And what we're going to find out, that the variable cost as a percentage are exactly the same if we're selling 2 units compared to if we sell only 1 unit. Why? Because, again, we're not changing the sales price, we're not changing the variable cost. The only thing that we're changing is the number of units. Contribution margin, what's going to happen with the contribution margin? That should stay the same, right? 80 divided by 200, yeah, looks the same, 40%. Now the question is, what if I sell, if I ask you, if I want to sell, let's copy this. If I want to sell 1,358,475 units, if I want to sell that many units, imagine somehow I can do that. As a percentage, how much will be my sales? Obviously, that will be 100%.
100%.
How about the variable cost? Again, I'm not changing the variable cost, I'm not changing the sales.
60%.
60%. How about my contribution margin?
40%.
40%. How can I get it? I mean, again, now we can get sales minus the variable cost going to give me the contribution margin. So is this make sense? So regardless how many units we're selling, our sales always going to be 100%, variable cost will be always 60%, contribution margin always going to be 40%. So now, once we know this, we know how the variable cost per unit behave, always stays the same. And the driver is the number of units. Fixed cost in total stays the same. Let's keep going here with our assumptions here. Now we want to find out, first thing obviously what we need to find out is how many units I need to sell in order to go, in order to be at the break even, right? That will be my first question. How many units I need to sell to get to the break even? Now, how can we get that? We have to work and think about it here. Before we go there, let's think, let's see something. So that's the first question that we need to answer. How many units we need to sell? So first thing first, sales are equal to the number of the units time sales price per unit, right? Correct?
Yes.
If I sell 2 units and sales price per unit is $100, my sales is $200. Well, the same thing is equal to the variable cost. Variable cost will be the number of units that I'm selling time variable cost per unit. So let's see, variable cost, if I'm selling, my variable cost per 1 unit is $60. If I'm selling 2 units, my variable cost will be number of units times the variable cost per unit, 120. Yeah, that's the one. Then the contribution margin, what will be equal to? How can I get the contribution margin? No, that should be the same, right? Because number of units is the number of units time. What will be the next thing that I need? That will be the contribution margin per unit. Because sales price per unit minus the variable cost per unit is going to be give me contribution margin per unit. So sales per unit minus the variable cost per unit give me the contribution margin per unit. So if I want to get the total contribution margin, what do I have to do? See how many units I'm selling, times the contribution margin per unit. It's going to give me my contribution margin. What was my objective? To get the contribution margin equal to the fixed cost. Which contribution margin? The one that I'm generating here. How I'm generating it? By number of units times contribution margin per unit. So if I substitute in this formula, what I'm going to have? I'm going to have my number of units times the contribution margin that I'm generating per unit should be equal to fixed cost. And that's and only then my operating income is going to be 0 when I have here 200, which has to come from the contribution margin per unit times the number of units that I'm selling. So the question is, can I find how many units I need to sell from this formula?
Yes.
How much will be? Number of units that I need to sell should be equal to what?
To fixed go divide into
Divided by, yeah,
the
Contribution margin per unit.
Per unit, yes.
Okay. So let's highlight this one and see if this works. So in our case here, in our scenario here, do we have contribution margin per unit? Obviously we have it. So our contribution margin per unit is equal to $40. Do we have a fixed cost? Yes, we do. Fixed cost is equal to $2,000. So can I calculate how many units I need to sell in order to cover my fixed cost? Yes. So the number of units, it will be equal to 2,000 divided by $40. Or it's going to be equal to number of the units should be equal to, not this one, this one divided by this one. So we need to sell 50 units. Let's see if that's actually true, because you can say, oh, that's very nice, but we want to see it. And I won't blame you. I want to see it too. So what's the idea here? Now let's copy those two, because one comes from the other. So if I'm selling 1 unit, that's my structure. So you're telling me if I change this one to 50, this one's gonna go 0? Let's see. If you change this to 50, now the sales price is gonna be this one. Total sales will be equal to this one time 50, and we're gonna log this cell. Let's format those one. Okay, so my sales went up to 5,000. How about my variable cost? My variable cost from 60 times 50. Well, let's lock it. It's going to be 3,000. So my contribution margin is 2,000. Fixed cost is fixed cost. That doesn't change. Still 2,000. My operating income is 0. Did we get what we wanted?
Yes.
Yes. So obviously this formula works. So let's highlight it, and that will be the first formula that you need to have. How to get the number of units in order to get operating income down to 0, or to get enough sales to cover your cost. Now, the second thing that we need to get is, I'm gonna copy this one, and I'm gonna keep going here. The second thing that we need to get is, what will be my total sales? What's the total sales that I need to achieve is equal to how much in order to be at the break-even point. So how are we going to do this? Well, obviously we have to come up with some formula. Right? Once we come up with the formula, then life is easy. What will be the formula here? I'm gonna go in this direction now. Well, I have my starting point. I know that my contribution margin should be equal to the fixed cost. And only at that point, I'll be at break even. Now the question is, how much sales I need to generate here in order to have enough to cover my fixed cost? Well, first thing first, let's see based on this formula, If I do this trick, contribution margin time 1 is equal to the fixed cost. Am I changing the formula? If I do this, am I going to change the formula? Am I going to change the result?
No.
No. So, but I already know that that actually cells divided by cells are also equal to 1, correct?
Yes.
Yes. So, having that in mind, can I go with the contribution margin times cells divided by cells equal to the fixed cost? Did I change the formula?
No.
No. But now what I have? Now I have on one side I have cells, on the other side I have time contribution margin divided by cells should be equal to fixed cost. Cells are cells. No questions about it. Now the question is, what's the contribution margin divided by cells? If I get contribution margin and divide it by cells, what that's going to give me? What did we get when we divided contribution margin divided by cells? We get 40%, right? Which is my contribution margin ratio. Make sense? So contribution margin divided by cells, that's going to give me the contribution margin ratio. And if I substitute in the previous formula, what I'm going to have? I'm going to have cells time contribution margin ratio should be equal to the fixed cost. Well, that's make a perfect sense because what you need is this number that you're generating here to be sales time the contribution margin to be equal to the fixed cost. So can I express my sales? Sales should be equal to fixed cost divided by contribution margin ratio. Now let's see if this actually is going to work. Let's highlight this formula and let's see apply it into the scenario and see if this actually is going to work. So, do we know our fixed cost? Well, we know the fixed cost. Fixed cost is equal to $2,000. Do we know our contribution margin ratio? Well, we already established the contribution margin ratio. We can get it from the units, we can get it from the totals, and we can get it from so many points of activity and never going to change. Why? Because always going to stay 40, 40, 40, 40%. We already established that. So my contribution margin ratio is 40%. Now, how much should be the sales I'm generating? Well, the 40% of the sales that you're generating should be equal to the fixed cost. So how much should be my sales? It's going to be 2,000 divided by contribution margin ratio, which is 40%. And if we do that, how much should be my sales? Sorry, this one divided by this one. And my sales that I have to achieve should be equal to $5,000. Only and only when I achieve $5,000 and 40% is my contribution margin ratio. That contribution margin ratio is going to generate from the sales $2,000, which will be enough to cover my fixed cost and to become the zero. Make sense? So obviously this formula also works. So we have now two formulas. One is for the number of units, and the other one will be for sales. That's to get to the break even. Obviously, not generating income, that's boring, right? We already see that, okay, if we selling 50 units, we're gonna get actually, let's move it this way. 1 unit here. We already saw if we're selling 50 units, I'm gonna generate $5,000 sales, variable cost will be 3,000, contribution margin will be 2,000. The other way you can get 50 times 40, that's going to be 2,000, and that's going to cover my operating income. Operating expense, fixed cost, and my operating income is going to be zero. But sitting on the zero, that's not fun. Now the question is, how many units I need to sell if I want to make more? Now, in that case, the only question that we have to ask ourselves is, how much more we want to make? And let's say we want to make $20,000. So if I want my operating income to be equal to $20,000, how many units I need to sell? That will be my only question. And the only thing that I can do is use this formula. But I need to modify the formula. How can I modify the formula? The number of units that you need to, actually the operating income that you want to generate, you're adding it to the fixed cost and modifying the formula. So if you want to generate 20,000, what you have to do is then add it to the fixed cost. And that's how you're going to get it. And run the calculation again. So we know our fixed cost was contribution margin per unit is $40. Fixed cost is $2,000. Now, the only thing that we need to add is the operating income that we want. And we already said that let's say we want 20,000. So how are we going to get the number of units? Number of units will be 2,000 plus the 20,000 that we want to make divided by 40. Now how many units we need to sell? Let's modify this formula. Plus the 2,000, 20,000. 18, that will be sales number, contribution margin, 18.5 should be here, like that. So if I sell And the formula says have to sell 550 units. If I sell 550 units, my operating income will be $20,000. So let's see if that's true. If I change this one to 550, then my sales will be this number time that number. Means that my variable cost is gonna jump to $33,000. I'm gonna generate $22,000 contribution margin, which is gonna cover my fixed costs with $2,000, and I'm gonna generate $20,000 operating income. That's the income that we wanted. So what you have to do in order to get the number is just add what you want to the fixed cost and run the calculation again. Now, how about the sales? If we're using the formula for the sales, well, the same idea. You're just adding the operating income into the fixed cost. Let's see if that's going to work. Now, let's pretend that we want, let's say 50,000 now. We don't want any more of 20,000. We want now 50,000. So what we have to do? Well, add it to the fixed cost. Whatever you want, just add it to the fixed cost. And once you add it to the fixed cost, run the calculation again. What was my calculation here? My fixed cost is still $2,000. Let's work with this one. My contribution margin ratio, still $40. Operating income that I want is equal to $50,000. So what I have to do, my sales should be equal to $2,000 plus the 50,000. So how much sales I need to generate? Well, definitely I need to generate 2,000 plus another 50,000 divided by the contribution margin percentage. So my sales need to be $130,000. And only when my sales are $130,000, my operating income should be $50,000. Let's see if that's true. I'm gonna use this calculation here, and I'm gonna flip it right here. Let's see if this is gonna work. So if my sales are $130,000 and I'm generating 40%, my contribution money is 40% of the sales, and my fixed costs are still $2,000, then my operating income is exactly where I want it, $50,000. And I get what I wanted with the sales that I want, that I calculate that I need to achieve. Make sense? Now we can go back to slides and cover slides a little bit, and then a few more. Gonna try to go as much as deep I can go through the slides, and at some point I'm gonna stop and I'm gonna start talking about the assignment. Questions so far? Sorry? Okay, let's go now to the slides then. Okay. Again, income format, contribution, cost, volume, profit, income statement format will be again sales, variable, variable, variable cost, total variable cost, contribution margin. Then we're gonna have fixed cost, total fixed cost, operating income. And if we have to put some numbers here, we have here selling price is $500. Variable cost for that particular unit will be $300. Fixed cost, as you can see, is $200,000. Now, the number of units that we're selling is 1,600. So this is if we sell only one unit. Now, selling price minus the variable cost is going to give us contribution margin. So from that one unit that we're selling, we're generating $200. If we're selling 1,600 units, that means we're going to generate sales at $320,000. Is that enough to cover our fixed costs? Yes, it is. So if we run the calculation, our operating income will be $120,000. Now, the total fixed cost of the break-even, we have to generate enough contribution margin to cover the fixed cost, since we know that the total fixed cost is $200,000. So what will be the number of units that we have to sell in order to generate that point? In this case, that's very easy to calculate because we need to generate 200,000 to match the fixed cost divided by $200 per contribution margin we generated from one unit. That means we have to sell 1,000 smartphones. Once we're selling one smartphones, we're going to be at the break-even. Now, what's going to happen if we sell one unit above the break-even? Here's the break-even point. Sorry, that's not the break-even. That should be changed, right? So should be here, if we generate $200,000, that will exactly match the fixed cost. It will be at zero here. What's going to happen if we sell one additional unit? Well, the contribution margin from that additional unit is going to flow to our operating income. So the first point, that's why it's important for you to go to the break-even, because after the break-even, every unit that you're selling, the contribution margin goes directly to operating income because your fixed cost free. Let's see this one. How a company can achieve the increase in contribution margin if what they have to do. How can I increase the contribution margin if nothing else changes?
Variable costs decrease.
Decrease. Only when I decrease the variable cost, then the contribution margin is going to increase. If I push the selling price down, my contribution margin is going to go down. Fixed cost, it doesn't affect contribution margin at all. Say here, ratios. How are we going to get the ratios? If you want contribution margin ratio, what do we have to do? Contribution margin per unit divided by the sales price per unit, or the total contribution margin. Let's say here, when we're generating, let's say here we can generate $320,000 contribution margin divided by 800, and that's going to give you exactly the same ratio of 40%. What that means is for every dollar that we're selling, 40% of that dollar is going to come to our operating income after we've covered the fixed cost. So again, if we're generating those sales of 100,000, increase by $100,000, what will be the increase in the income? So let's say we are the break even when we're selling enough, we're generating $500,000 sales. 40% is $200,000, enough to cover the fixed cost. What if we increase our sales with $100,000? What's going to happen with our operating income? Well, it's going to increase with 40%. Why? Because we cover the fixed cost, no more fixed cost. So those 40% increase in contribution margin, they're going to come directly to the operating income. What's the contribution margin? How are we going to calculate the contribution margin?
It's the sales revenue less variable expenses.
Variable expenses. If I want to calculate the gross margin, what will be the formula for gross margin?
Is it sales revenue less cost of goods sold?
That's correct. What if I want to calculate my operating income? Which formula I should use?
Just the sales revenue less fixed and variable expenses.
Can you see those? So this formula is going to give us contribution margin. This formula here is going to give us operating income. This formula here is going to give us gross margin. That one, fixed cost less variable cost, that actually doesn't give us any. Right? Okay, so you can see all the formulas, those three formulas here in this question. Let's keep going. The process of finding the break-even. Now, on the break-even, we need the level of activity, and we can calculate that level of activity by a mathematical equation or by using contribution margin or the cost volume profit analysis graph. There's even a graph here. Again, from the mathematical equation is that sales per unit is equal to the variable cost when determining break-even sales dollars is sales dollars times units, variable cost times units. So here should be having one time per unit is total fixed cost. Now the formula makes sense. When we substitute in this formula, we solve it for the Q, which is the sales volume, we should get how many units we need to sell. We have the sales price is $500, variable cost is $300, total fixed cost is $200,000. And when we save it for solve this formula for the Q, which is the sales volume or the number of units, sales volume is equal to the number of units. We're going to see how many units we need to sell in order to get a break-even. The contribution margin technique will be at the break-even point, contribution margin have to be equal to the fixed cost, the one that I show you on the Excel spreadsheet. So what that means? That means that the break-even point can be calculated either per unit contribution margin or contribution margin ratio. The number of units will be total fixed cost divided by contribution margin per unit. Here they not show you how they come up with that formula. So in our scenario, we have the fixed cost $200,000, contribution margin per unit is 200, number of units that we need to sell is 1,000. How can we solve the problem for the total sales? We're gonna use again, the fixed cost, divided by contribution margin ratio in this point, and we're gonna get a break-even point in dollars. So what's the common in those two? The fixed cost is common. Numerator is always the fixed cost. So the first thing that you need to know before you open your business, how much is my fixed cost? And then you start running calculation, how much sales you need to generate, or how many units we need to sell in order to get to the break-even. With the graph, how this is going to be expressed in the graph, that's how it's going to show on the graph. Let's make it bigger so you can see it. So what that means? Fixed cost is fixed cost. We always start with the fixed cost. Once we start with the sales, the variable costs coming. So what we have to do? We have to speed up the sales in order to get to the break-even. When the break-even is we're gonna cover the variable cost plus fixed cost plus all the variable costs that we generate since we start the sales. And once we hit the break-even, everything that we sell, it comes to our pocket. Let's make it smaller so you can see the question. So now, which one of the following? I already showed you the answer, but it doesn't matter. Which one of the following represents how the break-even point in unit is calculated?
Fixed cost divided by contribution margin per unit.
Right. Which one represents how the total sales to go to the break-even point is calculated?
A option.
A option, right? If I need the total sales, then we're gonna work with the contribution margin ratio. If I want if I'm using the ratio, I'm gonna get the total sales. If I using the per unit, I'm gonna get the number per unit. Number of units that I need to sell. So now sales in dollar units again. So now if we want to achieve more than the break even, what we have to do, we have to add whatever we want into the fixed cost and run the calculation again for the number of units or the sales dollars in units. So let's say this company wants to hit $120,000. How many units you need to sell? 1,600 units. As a dollar amount, total sales, adding again to 200,000 or running the calculation, they need to generate $800,000 sales to get $120,000 that they want. This is the other method that I show you on the Excel spreadsheet. How this is the same calculation, but different. Here we're using the equation method. Here we're using the formula method. Now let's see our question here. That will be the interesting thing. This company recorded net operating income of $51,000 when they're selling 280,000, when the sales are 280,000. If the company variable cost is 60%, how much is the fixed cost? So obviously here we need to run some calculations, correct? Before we do run that calculation, let's see what we know and what we don't know. I'm gonna flip this one question here so you can see my screen. This is the question that we have, correct? And this is the formula and everything that we need. Actually, yeah, that's the one. And this is the stuff that we need. So I can move the question right here. The question is what we know, what we don't know. That's where we are. So what we know the sales minus the variable cost going to give a contribution margin minus the fixed cost going to give it operating income. We know the contribution margin is equal, percentage is equal to the contribution margin ratio as a number, dollar amount divided by sales. We already know those things. Now, what we have in this formula and what we don't have. I have sales, right? So let's plug what we have. I have my sales. My sales are $280,000. Correct? One more zero. That's my sales. What else I know? I know my operating income. Operating income is $51,000. I don't know my fixed cost. I don't know my contribution margin. I don't know my variable cost. But I know that this one is 60%. So do I have enough information to get everything? That's the question here. That's what we're asking each other. Do I have enough information to get everything that I need? What you gonna say, yes or no?
Yes.
Yes. So how are we gonna go? There are two ways here. One direction is once you know this is 60%, get the variable cost. Once you get the variable cost, get the contribution margin. Once you get the contribution margin, you can get the fixed cost. The other direction that you can go is get the contribution margin ratio. Find out how much is the contribution margin. This one time the ratio is going to give you contribution margin. Once you have the contribution margin, make sure you're generating $51,000, and that's it. So how much is the fixed cost?
$61,000.
61,000.
61,000. Let's see if that's true. Now, what will be my variable cost? This one time 60,000. 168,000, correct? How much is my contribution margin? Well, this one minus that one,
112.
112,000. Is the 112,000 40%? No, sorry. This one minus that one. Is the 112,000 40%? Let's check.
Yes.
This one divided by this one. Give me 40%. Okay, so that's fine. So that's my operating income. That's my contribution margin. Fixed cost should be equal to contribution margin minus the operating income, and it's going to be 61. Make sense?
Yes, sir.
Good. Let's go back to slides. This is your solution here. 61 is the correct answer. Now the safety margin of safety. Margin of safety, that's something new now. It's where you are compared to the break-even. Make sense? So if my break-even point is, let's say, my break-even point is 1,000 units, and currently I'm at 1,600 units. How much is my margin of safety? Well, obviously 600 units in my margin of safety. So the margin of safety again is where you are compared to the break-even. Can be measured by number of units or can be measured by sales dollars amount. So if you're currently selling sales of $750,000, but you need $500,000 sales to achieve the break-even, you are $250,000 above the break-even. So that will be your margin of safety. Margin of safety can be expressed by dollar amount. How is going percentage amount, sorry. How are we going to be that? The margin of safety that you calculate here divided by the way you are. And that's going to give you 33%. So that means you're 33% above break even. Tell me what you think here.
The amount by which sales exceeds expenses.
Not the sale on the expenses. The amount of which the sales exceed the break even. Right? That's your margin of safety. We're talking about the break even. Remember where we are compared to the break even. Where the expenses are, we don't worry about that because the expenses are already in the break even. Means that on that point, our expenses, our sales are enough to cover up my expenses. If the break even is the point that my sales is enough to cover by my expenses, and I'm at 750, what's the difference from where I am at the break even compared to where I am right now? So that will be the amount of which sales exceed the break even sales. Or the data analytics, there are a lot of things that we can do in the data analytics. We can go with the decision making, what will be the best size, what will be the proper sales, what can we do to boost the contribution margin or to increase what's going to happen if we increase the contribution margin, how this is going to affect the sales, what's going to happen if we increase the fixed cost, and that's going to increase the sales, where it's going to be. There are a lot of interesting questions here, but we're not going to spend too much. I'm going to stop here at this point because, again, this is the chapter that we have to cover next week, and we're already halfway through. So I'm going to stop here. The rest is going to be given next week. We're going to stop at 43. If we have to do some repetition next week, we're going to do some repetition. And I'm going to stop right here.